Good morning and welcome to the third in the series of Responsible Pathways, the first in 2022. Many thanks for joining us today. We have a superb event for you. My name is Steve Kenny and I'm the Chief Distribution Officer at Square Mile. My job today is to guide you through the first part of the event. It has only been 2 months since our last event, and what a busy 2 months we've had. We've had Omicron, the surge, and now appearing to dissipate. We've had the suggestion to work from home, and probably, I know it's front of your mind, it certainly is mine, DP 21-4, the FCA discussion paper on the Sustainable Development Regulations and fund labelling. The industry continues its march towards responsible investing. Today's event has the focus of sustainability, which is becoming the most popular area for investors. But what does it mean? I am positive today that our speakers will help shed some light on this. Today's event is interactive, so please do submit questions. In the virtual world we are now presenting in, it is the only means of knowing if there's anyone out there. Today's agenda. We have asked 4 of our sponsors, 2025, what's your predictions in relation to responsible investing? We will hear from Aegon Asset Management, AXA Investment Managers, Jupiter, and Moreover, an affiliate of Natixis. We'll then hear from Mark Manning from the FCA, covering the ESG strategy and priorities. Please do take the opportunity to ask questions. We'll then have questions from the road, where we will hear from Invesco, Elgin, and Newton, part of BNY. I will then pass over to my colleague, Richard Roma-Lee, who will be chatting to Abby Llewellyn-Waters, Head of Sustainable Investing at Jupiter, who are one of the longest serving players in this space. How are they planning to develop their proposition? And what does sustainability mean in practice to an asset management firm? Rich will then pass over to my colleague, Anna Mercer, who is joined by a representative from Invesco, Elgin, and Newton, part of BNY. Anna will be exploring with her panel what is sustainability and how do groups integrate it into their propositions. I'm pleased to say that this event does qualify for CPD, and we'll be delighted to supply certificates should you so require them. We would also welcome your feedback and encourage you to complete the questionnaires that will be sent post the event. Finally, before we kick off with our first session, I wanted to thank our sponsors. You'll be hearing from 7 of them today. However, I would highlight the others who have contributed to date. Aberdeen, Federated Hermes, JP Morgan Asset Management, 91, Schroders, and T. Rowe Price. And of course, the 7 that you'll be hearing from today: Aegon Asset Management, AXA IM, BNY Mellon, Invesco, Jupiter, Elgin, and Natixis. My thanks to them, as without their support, this event would not be possible. Now, without further ado, the predictions 2025.
It's a big question to ask what we're looking forward to in 2025. I think there's no question that the COP conference was a disappointment as far as international agreements are concerned. However, I don't think that all is lost. There is a definite shift towards a sustainable future. For instance, we've seen a huge activity in the clean tech industry. It's really beginning to take off. I do believe that we're going to see that continue to thrive in the next few years. I also think we're going to start to see the beginnings of real impact of physical climate change and how that is affecting humanity, and that's going to spur a lot of people into action. And finally, a lot of companies have made bold commitments as far as net zero, and we're going to see those companies having to now live up to those commitments in the face of pressure from not only investors, but also from consumers and governments and legislations. So I think that the future is definitely rosier than we were led to believe at the end of the COP conference, and that we'll begin to see real movement in tackling this thorny issue of climate change.
In the coming years, I expect that we will see climate risk increasingly embedded in investment decisions, and that this will encourage the corporate world to make the transition more rapidly. In turn, this means more growing demand for clean solutions. I think that this will be coupled with a shift in focus from clients, both as they recognise that this climate risk will increasingly crystallise into financials and also as clients come to understand that it's possible to ensure their investments reflect their personal values. And this includes a growing desire for sustainability. That's something that we detect across all ages and client types. So happily, the implication of these changes is that capital will be increasingly available for solution providers. If it's correctly allocated, this should drive an acceleration in the pace of innovation. It is this that gives me optimism for our ability to address climate challenges we currently face.
Predictions for 2025. Given the short-termism in the market at the moment, it's hard to predict the next 3 days, let alone the next 3 years. What do I think? So climate, I think climate-related financial risk will be better reflected in asset prices. And I think that will largely be driven by greater transparency of the corporations, the businesses on their environmental impact. And the catalyst for that will be the mandating of TCFD reporting across the G7 as agreed in Cornwall, St Ives last year. What else? I think social equality will be a much more central focus, particularly as it's likely we'll get greater transparency around workforce disclosure, but also I anticipate a more maturing pay gap reporting to allow for that integration of social equality considerations. Biodiversity, I think, will be hurtled to the fore. And I think that will be driven largely by the fact that over half of global GDP is reliant on natural capital. And if we consider the global economy today, it is living beyond its planetary bounds, and we need to correct that. And I think this year, we've got the UN COP15 Convention for Biological Diversity, which will be an important milestone for natural capital and will serve as a catalyst to better support and include nature-based decisions into our capital allocation frameworks.
In the next few years after COVID, we do expect a more polarized society, including people trying to fight some quasi-unstoppable forces that will actually lead us to a more sustainable world. But that includes, for instance, the ever aging population that we're having to deal with. And we do expect in the next few years a breakthrough in the development of treatments for some diseases for which we currently don't have a decent solution. Equally, we do expect that millennials and women as an economic force will put more pressure on companies to become a lot more sustainable. But at the same time, millennials and women will also take up more management positions in those companies as well, helping them to become a lot more sustainable. In terms of energy usage, we do expect that the energy transition will continue to accelerate, including fossil fuel companies moving into the renewable energy market as well. But after COP26, with many companies and governments having committed to a net zero economy, we do think that the market will be more than big enough for all those actors to benefit. And lastly, we do expect technologies to evolve at a rapid pace as well. And for instance, in the automobile industry, after the semiconductor problems are over, we do expect that the electric car market will take a lot more market share there as well. And finally, in general, we do expect that demand for sustainable investment solutions will continue to rise at a very rapid pace. And here, regulation will also help us to get better and more data around sustainability profiles of the companies. And that will help us as an investor to really understand and monitor better what the impact is of all of our investments.
There were some interesting predictions there, but now I'm delighted to welcome Mark Manning from the FCA to share their thinking on strategy and ESG priorities. Mark will be giving a brief presentation, following which we have allocated some time for questions. So please do take the opportunity to submit questions as we go. Mark, over to you.
Thank you very much indeed, Steve. And it's a real pleasure to have been invited to this session this morning to talk, as Steve says, about some of the work that we've been doing at on ESG at the FCA and our strategy as we look forward into 2022. So let me start with a bit of an overview of our strategy. On Finance Day at COP26 last November, there was a clear consensus that finance is part of the climate solution. against this backdrop, we published a refreshed ESG strategy and set out some of the key actions that we propose to take on the regulatory front over the coming year and beyond. We set out a strategy that essentially builds on our existing work program, and we committed to actions under 5 key themes, the 5 T's that you see on the screen: transparency, trust, tools, transition, and team. For the bulk of my remarks this morning, I'm going to focus on the top 2, transparency and trust. But to complete the picture, under transition, we're going to be playing our part at the FCA in supporting the government's announcement at COP26 that the UK will be the world's first net zero financial centre. Under tools, we will continue to work collaboratively with others across both the private and the public sectors, and both domestically and internationally, to help deliver solutions to sustainability challenges and to advance good practice, including through our work with the Climate Financial Risk Forum, which we co-chair with the bank. And under team, we've set out how we're going to be looking to embed climate and wider ESG considerations as something of a golden thread through everything that we do as a regulator. And as part of this, we'll be looking to meet the government's expectation set out in a remit letter almost a year ago now that as the FCA, we will have regard to the government's commitments around the net zero transition in all that we do. So that, I hope, gives a little bit of a sense of the key areas of focus. But let me home in on transparency and trust. So our work on transparency is really taking place in the context of an environment of considerable change, both domestically and internationally. This slide highlights just some of the domestic and international disclosure initiatives that are shaping and influencing what we're doing at the FCA. Top of the list here, the Task Force on Climate-Related Financial Disclosures, which the UK has committed to introducing on a mandatory basis right across the economy, and which at the FCA we've been embedding into our rulebook over the past couple of years. Next on the list here is the government's roadmap to whole of economy regime for sustainability disclosures. Steve's already mentioned DP 21.4, which I'll talk about in a moment, but that really flows from the government's roadmap as published in October last year. Then, of course, there's the launch of the International Sustainability Standards Board under the IFRS Foundation, which ultimately aims to put sustainability reporting by corporates on an equivalent footing to financial reporting. And then at the bottom of the list here, the government's ambitions to make the UK the world's first net zero financial centre. And this would be including through the disclosure of net zero transition plans by listed companies and by financial services firms. Now, while these are primarily disclosure-oriented initiatives, they also aim to do much more than deliver transparency. They also aim to promote organizational change. They aim to to set a framework for individual organizations to think deeply about their climate and their sustainability strategies, and to make connections within their organizations on a multidisciplinary basis to meet these challenges. And they also aim to catalyze the development of a data ecosystem, which will ultimately improve access, quality, and capabilities right across the industry. So some really, really important steps there. And most recently, in terms of the FCA's work in this area, we published at the end of last year our final rules on the second phase of our TCFD implementation. This follows the introduction a year earlier of TCFD-aligned climate-related financial disclosure rules for our most prominent listed companies, those in the so-called premium listed segment. So in December, just before the holidays, we issued two policy statements. One setting out final rules to extend the application of that existing TCFD-aligned disclosure rule to a wider scope of listed companies using exactly the same languages in the existing rule, and also embedding the most recent TCFD guidance, including on transition planning. And then the second policy statement was implementing TCFD-aligned disclosure rules for asset managers, life insurers, and FCA-regulated pension providers, with these disclosures very much directed at clients and consumers, and including disclosure expectations at both the entity and at the product or portfolio level. So a very, very important step in our work. But now we build on this, and we're building on this in the context of the government's roadmap to sustainable investing that I mentioned previously. In this roadmap, the government set out an ambition of whole of economy sustainability disclosure requirements and sustainable investment labels, building on TCFD and extending beyond climate to cover wider sustainability risks and opportunities, and also integrating the forthcoming UK green taxonomy to capture sustainability impacts. Now, as part of this, the government confirmed that the International Sustainability Standards Board's forthcoming standards will form the backbone of the corporate reporting elements of the SDR, and that will set the tone for the disclosure requirements that will be introduced along the value chain. Given the scope of the FCA's remit, we'll be playing a central role in delivering on this ambition. We'll be responsible in particular for measures across listed companies, asset managers, asset owners, and investment products. And we'll be building on other relevant existing domestic and international work, including, for instance, our own guiding principles for the design, delivery, and disclosure of sustainable investment products, and activities at bodies such as IOSCO. To inform our policy design on the aspects that relate to asset managers, asset owners, and investment products, we issued DP 21.4 in November, and that discussion paper closed earlier this month. We received very strong feedback, around 100 comment letters, and we're in the process of reviewing these now with a view to finalising proposals by mid-year. Let me just say a few words before I close about what is in the discussion paper and where we're really focusing our attention in this period. In particular, we anticipate 2 layers of disclosure. First, a concise and accessible consumer-facing layer, pithy, consumer-facing ESG fact sheet complementing the key investor information document, with key sustainability-related information about the product. And this would be supported by more detailed product and entity level disclosures that go into more depth, and that perhaps will be more relevant to more sophisticated investors or institutional investors. And ultimately, sitting above and informed by these disclosures would be a sustainable investment label, the aim of which would be to help retail investors navigate what is admittedly quite a complex ESG investment landscape, and help them identify and select investment products that meet their needs and preferences. In the discussion paper, we set out our initial thinking on these investment labels, and we're really seeking, or we have sought, feedback on a possible approach with 5 categories of products differentiated on the basis of their sustainability characteristics and the proportion of the fund that is invested in sustainable products, projects or activities. And that would leverage, for instance, the UK taxonomy. So our discussion paper was open for comment until earlier this month. As I say, we've had fantastic feedback. The aim now is to analyse this feedback and also engage with a disclosures and labelling advisory group that we established with a number of industry participants with a view to consulting on formal policy proposals by the middle of the year. With that, let me just close with our next steps. So that is a big priority for us to develop and consult on these proposals around sustainability disclosures and investment labels. Also in the first half of the year, we are going to be feeding back on responses to a discussion chapter on ESG and capital markets that was included in our TCFD consultation last year, but not in the policy statement that we issued just before the holidays. And importantly, we'll be stepping up our work on transition plans, working with the government and the Treasury's new transition plan task force that the Chancellor announced at COP26. And we'll be looking to see how the conclusions reached by that task force ought to be reflected in our rules framework. In parallel, of course, we will continue to work closely with our partners at IOSCO and as part of that, work very closely also with the IFRS Foundation as their work to introduce standards under the new International Sustainability Standards Board continues. So we have a very ambitious work program ahead, and we look forward to continued very strong engagement with industry participants as we continue that work. For now, back to you, Steve.
Thank you, Mark, and thank you for sharing that. I think, you know, the industry is desperately looking for guidance on this, and therefore it's always good to hear from your good selves. I think the opening question I would ask that's been sort of framed by a couple of people is, do you as the FCA envisage any changes to the suitability process that advisors have to follow? And I think the thinking here is, I know when we talk to advisors, they've looked at what Europe has embraced in terms of included in MiFID II, there's now a requirement under suitability to ask the client their sustainability preferences. And I think the UK advisor market is probably expecting something comparable. Do you see anything like that coming into play?
So it's a great question, Steve. And as you'll know, in the government's roadmap, which I've mentioned a couple of times in my remarks here, the roadmap to sustainable investing published in October last year, the government did signal that rules on rules for financial advisors will be forthcoming. But unfortunately, the details around the timing of that are not yet available. What I can confirm, though, is that a key aim here will be to ensure that advisors take sustainability matters into account in their investment advice, and that they do understand investors' sustainability preferences to ensure the suitability of the recommendations and the advice they provide. Ultimately, we will ensure that requirements are fit for the UK market, and we will look to previous European experience in developing rules for the UK. What I would say, though, is that in many respects, ESG is already in scope when advisors give investment advice. Under existing rules, for instance, firms have to act in clients' best interest and collect all necessary information when providing advice to understand the client's investment objectives. And so in that context, the suitability rules within our conduct of business rules already essentially require for firms that provide advice to consider those investment objectives. And the rules set out the information on objectives that a firm is required to consider, but this is not intended to be an exhaustive list. And we have seen that many firms already appear to be including ESG in suitability assessments. And so to some extent, regulation may be lagging market practice in many ways. So I think it can reasonably be argued that proper consideration of clients' investment objectives as part of the suitability process should also include consideration of ESG. So it would be reasonable to expect firms to be asking clients about their ESG preferences and taking the responses to those questions into account when assessing options and making recommendations. I think as we work with Treasury towards some proposals in this area in due course, we would certainly be very keen to engage with the advisor community. And for those that are already down this particular path, we'd be very keen to hear what works, what frameworks they consider helpful, and what challenges they have been facing. I hope that's helpful, Steve.
No, it's great, Mark. And one of the other questions that I think is worrying advisors, or one of the concerns, is the volume of information that is now going to be coming down the pipe, for want of a better expression, concerning this area. There is a worry that it will be so complex and so full of industry jargon that to Mrs. Miggins, it will be confusing rather than helpful. And so in that regard, is the FCA going to give some guidance as to how this can be boiled down to digestible information to help the end consumer make informed decisions with their advisor?
Absolutely, Steve. So I think if I can just refer back to, I don't know if my slides are still on the screen. Are they still on the screen? If so, there is I mentioned the tiered structure here with 2 layers of disclosure, one which is intended to be very much consumer facing, and the other which is a bit more comprehensive. In that consumer facing layer, what we're really focused on is what are the key sustainability characteristics, themes, or objectives of a product? What are the absolutely essential metrics that consumers may wish to wish to consider when making a decision about an ESG related product? And in order to ensure that that consumer facing layer is fit for purpose and is accessible to retail consumers, we're doing a number of things. First of all, we've just completed a consumer experiment, an online consumer experiment that that basically assesses the accessibility of different styles of disclosure, different use of language, different degrees of depth and detail in a mock-up of an ESG fact sheet for a product. That experiment was run at the back end of last year. Our behavioural design unit economists are currently working through the responses to that, and that would be a really important input into our thinking in this area. We're also engaging with others in the industry who are also looking at consumer communications, use of language, naming conventions in relation to products, including colleagues at the Investment Association and at the Investment and Savings Association. And we want to gather all of this information to really ensure that what we come up with here in that consumer-facing layer of disclosure is fit for purpose, is truly going to help consumers navigate this landscape and cut through some of the current complexity and potential confusion, including around use of language.
Cool, that's great, Mark. I'm going to merge 2 questions, if I may, so in order I can keep to time. A number of advisors have asked us about when they're trying to assess sustainability propositions in the marketplace at the moment, the tools to assist in this area are, in their view, words, flawed at the moment. Does the regulator have a mind's eye to look at that? And if I may, the sort of follow-on question, which is a slight adjunct, is language is one of the big concerns in the marketplace, and the FCA have decided on ESG as its umbrella term. Our industry body, the Investment Association, have decided on responsible. In Europe, they're using sustainable, and then the Treasury document that you referenced, they use sustainable more than ESG. Do you see the regulator trying to ensure that we have one term that the market adopts? So if we could tackle the first point, which is about tools to assess what's currently in play, and the second thing about language in terms of trying to assist the advisors, because that's one of the big problems they highlight to us.
Yeah, thank you. I'll try to be quick, because I appreciate that we're pretty much at time. So on the first point, one of the so there are two parts of our current strategy and the current commitments that we've made in that strategy document that hopefully get to this question of tools for assessment. So first of all, we've been very clear that one of the things that we want to do here is ensure that the ecosystem that surrounds the sustainable finance market, and in particular the data ecosystem, is fit for purpose. So one of the areas that we're looking at quite actively at the moment, and on which we sought feedback last year, is around ESG data and ratings. So hopefully the work that we do in that area will help to ensure that the data ecosystem can really assist all financial market players as they pursue their strategies in this area. The other big area of focus, of course, is continued work of our Climate Financial Risk Forum, which is really all about trying to ensure that that the industry can drive towards best practice in terms of the way in which it operates and assesses climate-related risks and opportunities. And some of that can be leveraged in relation to wider sustainability matters as well. On the point about terminology, we do appreciate that the language in this area can be quite confusing, and key terms such as ESG and sustainability are often used both loosely and interchangeably. Sustainable, for instance, is sometimes used to refer to the narrower topic of environmental sustainability rather than also incorporating matters such as social sustainability. In our work, we've used ESG to capture the key dimensions of wider sustainability: planet, people, prosperity. But we recognize that more needs to be done to ensure that there is clarity of terminology across the market. And we are hoping that as we work towards proposals flowing from the feedback we received to the discussion paper and set out a framework for sustainability disclosure requirements and investment labels, that will in and of itself help the industry to coalesce around certain key terms and use some of those terms also in mapping to naming conventions for different types of products. That can certainly help to cut through some of the confusion. But this is a journey. We're in a very, very dynamic phase of ESG at the moment, and things do need to coalesce and settle down to effectively ensure that this market can mature and mature in a trusted way.
Brilliant. Mark, I want to thank you on behalf of today's audience. I think you've been excellent, very honest, and given us a real insight into the regulators' thinking. So I do thank you, and thank you for taking today's questions. I now have to move on, regretfully, because I know we could talk about this for a serious amount more time. So, Mark, thank you very much. Next, at Square Mile, we have 5 members of the team who meet advisors on a regular basis. Today, we have Jamie Farquhar, who is asking questions of our 3 asset manager experts. These are questions that have been put to Jamie when he's been out and about Our experts are from Invesco, Elgin, and Newton, part of BNY. After the questions from the road, my colleague Richard Romalee will be taking over, and he'll be interviewing Abby in terms of talking about sustainability at Jupiter. Rich will then pass on to my colleague Anna, who is head of 3D investing, who will moderate a live panel with 3 superb speakers on sustainability. Please do continue to take the opportunity to ask questions. So without further ado, let me pass on to Jamie and get the questions from the road.
Hello, and thank you for joining us today. I'm Jamie Farker, Business Development Director at Square Mile, and I'm going to be asking 3 of our sponsor groups some of the common questions that we tend to hear from our clients about responsible investment. What is your approach to managing your exposure to unintended controversies?
At Invesco, our approach to managing unintended controversies focuses mainly on our internally developed tools. So we have a big focus on our internal ESG assessment rating tool, ESG Intel. This is a proprietary methodology that incorporates not only controversy monitoring, which can affect a score after the fact, but includes a scoring methodology for multiple factors across ESG. We use diverse data inputs, including some NGO sources, which can sometimes be on the leading edge of identifying ESG controversies themselves. So this helps us to understand areas of poor company performance. We also, ESG Intel is used across investment teams globally. So those outputs, including controversies flagged, come up in regular meetings with companies and in collaboration with the ESG team as part of systematic exchanges and regular reviews. We also have an additional global focus tool, which is called Focus Intel, where we monitor and identify key risk factors to prioritize issuers by risk category. So this enhances our engagement with companies and is an additional factor for identifying exposure. And we can specifically monitor exposure across investment centers globally, which helps us identify kind of key areas of risk for different investment teams. And the global ESG research team keeps up to date with key risk factors which can cause controversies, which ensures we constantly evolve our Focus Intel tool according to changing global ESG risks. Climate and net zero being a major focus for us at the moment, post COP26, and we were present at the World Climate Summit in Glasgow. And finally, I would say the significant increase in the ESG team resources at Invesco over the last 12 months, up to 22 people, signifies the strategic importance of ESG to Invesco and our long-term commitment and increased internal collaboration on ESG.
Why is engagement key to change?
At Elgin, our purpose is to create a better future through responsible investing. Engagement is at the heart of our investment philosophy, allowing us to deliver relevant investment solutions to our clients while delivering positive change to tackle societal issues. Through holistic engagement and collaboration, asset managers can drive progress and change across a range of environmental, social, and governance issues, setting minimum standards across markets and helping companies on their journey to a sustainable future. Engagement is our way to accept responsibility to tackle these challenges, because without change, we will not achieve the desired outcomes. Most of the identified challenges are global in nature that require a global solution and hence global collaboration. No company, sector, or even country will on its own be able to address, for example, climate change. Coordinated engagement efforts worldwide are necessary to effect the necessary positive change. Challenges like the climate emergency also mean it is vital that investors retain a seat at the table. By excluding them wholesale, investors lose the ability to push companies in a sustainable direction, for example, towards net zero carbon emissions. Engagement with consequences is what is needed to effect change. This involves leveraging Elgin's scale across asset classes, regions, and private and public markets, bringing together our investments and stewardship teams to speak with one voice as part of our overall approach to responsible investing. Exclusions, in particular those outside the commonly accepted areas of controversial weapons, coal, and others, are a useful tool for asset managers to have, though the effectiveness of exclusions should always be carefully considered and only used if the engagement process has failed to yield the desired results. And there are other sanctions we can apply before taking this drastic step, not least by using voting rights. In doing so, we believe we can mitigate risks, unearth investment opportunities, strengthen long-term returns for our clients, and deliver the positive change the world urgently needs.
Are you signed up to the Net Zero Asset Manager initiatives? And what does this mean?
Newton has signed up to the Net Zero Asset Manager initiative, and we are currently in the process of defining our response. This is an initiative that is aimed at remedying climate change from an investor perspective. Generally, the Net Zero Asset Manager initiative has a series of requirements, the most notable ones being that the asset manager commits to working with clients to help understand and achieve their net zero goals, and setting an increasing level of assets to be managed in line with net zero principles by 2050, complemented with a 2030 interim target. And what does this mean in practice? It's relatively easy to have a low carbon portfolio. You buy technology, retail, light manufacturing, and you can have a carbon footprint far below global benchmarks. But this is a superficial approach, as it doesn't actually tackle any of the real world problems around how we power, move, feed, and shelter ourselves. It also doesn't take account of any of the physical risks from climate change. And finally, it's a heavily constrained investment approach, which is likely to be detrimental to investment performance. As a result, investors needed to design a response that enables them to thread the needle through the objectives of meeting client expectations, taking advantages of opportunities and mitigating risks related to climate change, and encouraging change through stewardship activities of voting and engagement. The two final pieces I mentioned there around managing risks and engagement are likely to be two crucial areas for long-term active asset managers to help foster real-world change. If the risks are too high and the company is not transitioning, asset managers will vote with their feet and sell securities or engage with management to encourage change. Of course, we are acutely aware that addressing climate change requires further coordinated regulation, technological innovation, and consumer support. But this initiative represents a good starting point for investors to frame their response to climate change. Thank you for your time.
Good morning, everybody. My name is Richard Romer-Lee, and it is my pleasure to chair the next session. And I'm thrilled to be joined by Abby Llewellyn-Waters, who is Head of Sustainable Investing at Jupiter. Abby joined Jupiter in 2006 and has dedicated her career to sustainable investing. She is also fund manager of the Jupiter Global Sustainable Equities Fund. Abby has, and she'll be too humble to say this, has received recognition for her investment performance, her approach to ESG integration, and she also collaborates on several industry initiatives, including as an author for the CFA Institute on climate and investing, on the Climate and Investing Certificate. On top of that, Abby's also been recognised for her contribution to address the structural hurdles that women in investment face. And as such, she's an ambassador for the Diversity Project and is a member of the 30% Club Investor Group. Welcome, Abby. Thank you very much indeed for joining us today.
Thank you for having me.
It's our pleasure. And before we crack on, may I remind the audience, you can ask questions via the Slido app. Please feel free to do so. This is your session and we'd love to hear from you, and Abby would love to answer your questions. Plus, selfishly, it will make my job easier as well. So first of all, Abby, let's explore sustainability in terms of what it means to you and what it means to Jupiter, the company for whom you work. So let's talk about you first. You've dedicated your career to sustainability. What does it mean to you?
So sustainable investing for me and how I invest really is about identifying those companies that are leading the transition to a more sustainable world. And we've just heard from the regulator about how dynamic the market is at the moment, and clear definition is so important. And I think the comments that I would pick up from that previous session would be, for us and the strategy that I run, it's a broad intersect. of balance of stakeholders. And what we mean by that, when we talk about those companies leading the transition to a more sustainable world, we're really talking about the balance of three core stakeholders, and that is the planet, on which we all depend, the people with whom we all coexist, and the profit that we all require for our long-term savings and pensions. And so when we're thinking about this, it's companies who understand and manage their business with those core stakeholders in mind. So companies mitigating their environmental impacts, treating people fairly, whether they're employees, customers, suppliers, thinking about delivering the resilient long-term returns. And those are the types of business for us, from a global sustainable strategy perspective, that we look to invest in.
Okay, thank you. That's really clear. And we'll come back to that, if we may, in a minute. But you make a point about seeking to invest in businesses that get that balance between the stakeholders correct. So for a business like Jupiter, how does a business like Jupiter embrace these changes around us? And in that, I acknowledge that Jupiter, I think, the first foray into this world was the launch of the Ecology Fund, I think, was back in 1987.
Yeah, absolutely right. So 30 years of a strong footing in this place. And if we go back to the 80s, that strategy was largely launched as one of the first green investment products in the UK market as a response to the nuclear fallout of Chernobyl that we saw in 1986. So, there was an opportunity to align client savings to environmental objectives at that time. And so Jupiter was really pioneering. And I think it would be fair to say that the current focus of the management and the board is very much to evolve rapidly and meaningfully our credentials in this space. We launched the Global Sustainable Strategy, which provides clients with a broader alternative to global equities that includes that stakeholder balance that we've just discussed. But at a firm level, we recognise we have a dual footprint. There is the footprint of our investments, and there is the footprint of the corporation. And what we are doing at the moment, with significant ambition, is aligning those dual footprints. So we have committed an investment level on the Net Zero Asset Managers Initiative, 41% of our AUM. That's effectively our developed market equity strategies across the piece, not just sustainable. Our sustainable funds have already aligned to those frameworks, but the broader investment offering is being aligned with interim targets in 2030. That's an ambitious allocation of AUM to align to a net zero economy, which supports 1.5 degree climate scenario. But we talked about that dual footprint, we also hold ourselves to the same account. So social aspects, which often get overlooked at an investment level, we've committed to the UN Global Compact alignment, which is 10 guiding principles that incorporate human rights and anti-corruption, among others. But we're also committing ourselves to being a living wage employer across our global footprint. So it's that recognition of the duality of our role and combining those and holding ourselves to the same account. And I think this is perhaps something we'll come on to, holding ourselves to the same account that we would hold our investee companies to. And we see that with management objectives, and we see that with our remuneration plans. All material risk takers at Jupiter have ESG objectives in their performance criteria, no matter what fund they run. That is, a significant commitment at a corporate level to address that broader stakeholder footprint. And it's a really exciting chapter for us as we better position our business to support our clients and the increasing demands that we see there as well.
So thank you for that. So that's all about the authenticity and credibility of Jupiter as an asset manager, notwithstanding the work that you and your team do to live to and demonstrate the same values that you would expect investing sustainably on behalf of your clients in any company that you were seeking to invest in.
That's Jupiter more broadly, as well as, of course, from our product position, from the portfolio that I run, from the environmental solutions franchise that you've already alluded to, launched in the 80s. Obviously, we are significantly progressed on that basis. Our portfolio is already aligned to a net zero economy by design of what we are trying to achieve at a product level, but more broadly, the house is moving across our asset classes to deliver these environmental and social goals more broadly.
Okay, wow, that's an extraordinary change in a business which has obviously been around for some time. So developing on that, and we've heard today already the complexity of the broader subject that we're dealing with. We've heard about the challenges in data, in disclosure. We've heard about we're on a journey here. I know you think it's very important to have an in-house skill set in terms of helping you both invest and develop your proposition. Can you share with us why you believe that's so important?
Yeah, and it's a great question. So everything we've just heard from Mark, everything we've heard from the advisors about trying to navigate this space, if the material risk takers, if the capital allocators are not integrating this research throughout their investment framework, and if they're not doing that research themselves, it's really hard to understand the influence of those considerations on the capital allocations that are being made. You know, for us, it's so important that we don't outsource those decisions either externally or internally. And the material risk takers, the fund managers, the analysts, we own this research in the context of when we're generating investment ideas. And I think it's understanding that balance of those stakeholder needs in the context of capital growth objectives that's so important. And I do think we are on a journey. We've heard about that journey. We've heard about the dynamism. You know, the regulators trying to scaffold trust in a nascent chapter where we lack standardization and harmonization of reporting. We're reliant on companies reporting themselves, largely because of lack of standardization on an unaudited business basis. So if we aggregate all of those factors, then I think it becomes increasingly important for the fund manager, for the analyst who are putting ideas into portfolios, to understand the granular aspects of these considerations in order for them to have the influence that the regulator has cited there in the context of those client outcomes through those balance of stakeholder needs. And perhaps we can get on to some illustrations in a bit, but that would be my broader case. And I think transparency evidence, you know, we have an annual impact report. That is a byproduct of our investment process. It is not a marketing document. It is a byproduct of our research process that goes to great lengths. And this comes back again to the previous sessions, goes to great lengths to evidence and provide transparency to the underlying clients and exactly how their savings are delivering those real world outcomes. It's not score orientated, it's not aggregated data. This is contextual narrative with real world outcomes. And when we're talking about this, we've just heard Steve's point that he's hearing from the advisors on, what was it, the jargon and the complexity, I think he mentioned right there at the end of the last session. You know, we're looking to avoid that in our reporting. We see that. So when we're communicating with our clients, how many jobs are created? How many litres of water have been cleaned? How many people receiving financial services for the first time? You know, these are tangible, accessible evidence for our clients, for our investors, on exactly how their savings support and contribute to a more sustainable world.
Okay, thanks. And that's about evidencing, as you call it, the real world outcomes that your investment and your investment strategy is delivering. Before we move on to some of the themes you're investing in, let me ask you a question as a fund manager. And clearly you've been doing this for your entire career, but there's a lot of the market, a lot of the world are catching up. Essentially, you're now having, as a fund manager, you're having to consider not only the financial objectives and outcomes that you're seeking to provide for your customers, but also then those real world outcomes. Can you give us an insight into how you go about that, how hard it is to create that balance, as you referred to beforehand, and I suppose some confidence about how you do that, because it must be really difficult.
It is challenging, but I think we have a disciplined, rigorous process. We have experience, we have specialist experience across the team, a deep knowledge set of understanding and navigating these data sets. We also understand what a false positive looks like. And what we get most excited about is the opportunity within the false negative set. And we can come on to that. I mean, I suppose I would take a step back and just from a broader perspective, as a capital allocator, as a fund manager, just say this is a rational, logical approach to investing, in my view. We're allocating capital on a 5-10 year forward basis. We have a very long-term view on the market and the companies that we're investing in. We're investing in structural opportunity, which typically tend to be closer to a decade-long opportunities, and we'll come on to some of that positioning shortly. And ultimately, what we're trying to do is take account of systemic external risk. We see that with environmental risk. It's our very strong thesis that becomes internalized cost of the business. So, polluting the air will no longer be a cost borne by society. It will either be borne by the company themselves, or they'll have to pass that cost through to their customers. So it'll impact margin or market share, which will impact profitability. So when we come back to that very primary objective of capital growth, capital allocation, a 5-10 year view, which companies are better positioned to navigate that trajectory on the basis of the inevitability. We saw that with COP26. This is inevitable. It is not if, but when these environmental externalities become priced into the cost of business. And you mentioned the authorship of the CFA. That goes very much to the heart of it. Asset prices reflecting the climate-related financial risk. So investing in those companies who've mitigated that risk, who are investing in their processes and procedures to not have to bear that cost by having a lower carbon footprint. Our fund's 80% lower than the index, very low carbon footprint on a scope 1 and 2 basis relative to the market on a dollar invested basis. Those companies who mitigate that risk are intrinsically better positioned to deliver those capital returns that the industry was born on. And so for us, it's a rational, logical approach to capital allocation, particularly given the timeframes with which we're focused on.
And in that regard, that rationality and logicality is very much, these are businesses which are sustainable in the truest sense of the word, right? And if they're not, they're going to struggle, right? And the returns are going to struggle. So
the global economy is operating beyond its planetary bounds.
Yeah, exactly. So it becomes, yes. Okay. Yeah. So let's try and illustrate for our viewers. Let's try and illustrate some of the themes that pervade what you're looking at the moment. Perhaps you can illustrate that with some ideas of some companies and stuff like that. So we've talked about commitment to net zero or transitioning to net zero, and I know decarbonisation is a big theme for you. Can you talk? And you've talked about the structure of the portfolio in terms of the impact or its positioning relative to the index. Can you talk about how you're pursuing some of the decarbonisation investment strategies, and perhaps touch a little on any engagement that you get involved in pursuit of those objectives?
Yeah, on aggregate, the portfolio is a low carbon portfolio. So those clients who want to align their savings to the Paris Agreement or net zero or 1.5 degree climate scenario, they're all complementary. At an aggregate portfolio level, we seek to deliver that through companies that have positioned their businesses to align to those climate objectives. So at an aggregate level, we're decarbonised. On an underlying basis, and we do have a huge amount of engagement, and typically we're looking for actionability and measurability. And I think that's a really important point when we're talking about this, because ultimately you have a 10-year tension. You've got the average CEO in position for 7 years. Good governance dictates 9 at a board level. And then you've got a 30-year climate strategy that needs to be delivered. So we look for short, medium, long-term targets that are actionable and measurable so that we can understand progress against those targets. So that's a really key point for us when we're thinking about these things. I would point to some of the underlying structural allocations within the portfolio, which I think are quite interesting and bring that stakeholder balance to life a little. So if we look at something like financial inclusion, there are over 1 billion adults in the world who still don't have access to financial services. That's astonishing given where we are on economic progress over the last century. And so for us, when we're investing, and about 15% of the portfolio is allocated to financial inclusion, when we're allocating to that structural opportunity, we're looking at those companies that support digitalization of cash flow. And just to give you an example, we're invested in a company in Kenya, and that company, traditionally a telco company, telecommunications company, it moved into mobile payments over a decade ago. And when they made that move from a technology perspective, what we saw at a social impact, a real world outcomes perspective, about 26% of the Kenyan adult population at that time had access to financial services. Roll forward a decade, that's closer to over 80% of the adult population of Kenya because of that mobile payment solution that was brought in. Really impactful, particularly for rural communities, where it would have taken days to travel to an urban centre to access those financial services. So when we think about the millions of lives on a real world outcomes perspective that's impacted, that's the type of balance that we're looking at for companies who have got these solutions on a structural basis that deliver an impact multiplier and also attractive returns.
That's fascinating. And just picking up on a point you made in there, and again, I wonder how you deal with this. And you referred to it in the video at the start of this session, where you made a remark about the short-termism in markets. You've talked about, let's call it, the medium-termism of the life of a manager of a company, the long-term objectives you're trying to deliver, and let's face it, the short-term volatility in markets, which has to respond to all sorts of different things. What's your message to investors in two things? First of all, about how they should try and ride those out, and secondly, about how you react to those short-term, the short-termism when you're trying to deliver these long-term goals.
Yeah, it's a challenge. It is a challenge. And you also in that long list of 10-year tension, the political landscape is typically on a 4-year democratic cycle as well. So you've got all of these tensions in delivering these long-term aspirations. And I think for us, discipline, rigor, we certainly don't get caught up in the short-term noise. We're mindful in order to understand, to be able to communicate with clients what's happening, but it's not something that we typically respond to on a portfolio construction basis. This is about finding the highest quality companies in the market that are going to compound year after year. And this is the operational resilience in companies. We look through the market sentiment, we look through the short-term noise to look at, are these companies delivering on an operational basis? And a very simple technique, we look at the portfolio. I mean, behind me, actually, my screen's blurred, you can't see it. The portfolio is running, you look at those companies on a daily basis. Would you buy those companies today on a 5-10 year forward basis? And if the answer is yes, then you know you've made the right decision. And so I think that discipline, that rigor, that understanding to look through some of that is a really important characteristic, particularly when we have things like biodiversity, which I know is a topic that you're also interested in, given the nascency of that and the importance of that going forward.
So we'll come on to biodiversity in a second. So the message for investors, though, is I suppose there's going to be some volatility, as is always the case with equity investing. I suppose for our advisor audience, what's your sense on, is that alongside, is that sort of similar to what you should expect from the broader market? Is it going to be lower? Is it going to be greater? How would you set their expectation for the ride they would expect if they were to invest with you?
Well, for our strategy, for the global sustainable strategy, actually our volatility has been low. So we have taken on very similar risk profile to the market, so effectively to a passive, and delivered a 5% annualized alpha or outperformance. Oh, this industry loves jargon. So apologies for that. It's hard not to get caught up in it sometimes. So yeah, so I think it's not always the case. And it's a really important characteristic of our portfolio, and where certainly why clients have been selecting us since launch is because of that attractive volatility characteristic. So it's not always a given that there will be volatility. Equity markets, of course, have volatility. We've seen that this year, and the reflation trades and the knee-jerk reactions we've seen. And if we go back to the Pfizer announcement, it was a very strong repositioning in the market in November 2020 as well. So, and the advisors will be familiar with those dynamics. So I think for us, we're choosing these companies on a 5-10 year forward basis, and that's a really important time horizon to be comfortable with when allocating in this portfolio.
Okay, thank you for that. Now, in the video earlier, you mentioned forthcoming COP15 and biodiversity, and again, you referred to it just now. Can you talk a little bit, please, about why you're so excited, if that's the right word, or about biodiversity, and perhaps again how that theme is playing through in how you're investing?
Yeah, it's a big topic, and I think it will be becoming increasingly important for everybody as climate change has done. And so if we think about global GDP, over half of global GDP is reliant on natural capital. And I think that's a significant statistic to be aware of. We have the Dasgupta review, which has a very concise and accessible executive summary for those interested, publicly available. I would encourage you to look at that and the influence and context of natural capital on the global economy. So if we think over half of global GDP is reliant on natural capital, we have very limited ability to measure the impact of companies in the context of natural capital at the moment. We've got a potentially historical COP15 Convention for Biological Diversity happening in China, Omicron allowing. This year, second innings started in October last year, this is the second half, where they are looking for a 21-point agreement that will be to nature what Paris was to climate. So I want the market to be aware of this, to advisors to be aware of this. It becomes an increasingly important feature. We know about TCFD, the Task Force for Climate-Related Financial Disclosure. There are so many acronyms in this space. I know we don't help ourselves with that. There's also TNFD, Task Force for Nature-Related Financial Disclosure, which will be launched in 2023. We anticipate that to follow a similar pathway to TCFD in the mandating of it across the G7. So we should anticipate that these issues will become more influential to asset prices in the context of capital growth objectives. And for us, given the nascency, given the lack of transparency, given the lack of data, engagement is absolutely key. So last year, we did a big biodiversity engagement program across the portfolio. We've got one company, Brazilian bank, and we wanted to engage them. They've got market-leading financial inclusion strategies in Brazil, but we wanted to engage them on biodiversity and understand, understand how their loan book, how vulnerable their loan book was, whether their loan book was supporting deforestation in the Amazon rainforest. And it was a really fascinating engagement meeting because not only had they brought in covenants to their loans of their customer base, directly related to wrongful deforestation. And we asked about the enforceability of those covenants on the basis of wrongful deforestation. They put huge investment into geospatial data so they could map what was happening in the Amazon basin in relation to where they knew they had loans related to assets. But they discovered there was no digitalized or no comprehensive digitalized land registry. So in order to be able to deliver on your biodiversity objectives and natural capital on the basis of deforestation, this company now has to work to digitalize land ownership or land register of ownership across the Amazon basin. So it's really fascinating and complex, nuanced and challenged, but it's that kind of engagement, from a shareholder perspective that will drive that change and that greater momentum behind addressing some of these issues and how corporations respond to it. But a really fascinating engagement program, which we're happy to discuss at a later date. I'm conscious of our time. We've got a huge agenda that we wanted to get through today.
Amazing, and I just thank you for that. Just a quick question, because I know we're hopefully coming towards the end, maybe not quite so quickly in the developing rather than developed markets of this wretched pandemic. And I know another theme that you have pursued or you are pursuing through investment is one of preventative healthcare. So it's a slight tangent to that. Can you briefly share what you've been looking at there and some of the benefits for your customers?
Yeah, so about a quarter of the portfolio is invested in what we describe as preventative healthcare. That's companies that are enhancing patient outcomes and reducing the cost of healthcare, either borne by state or individual, depending on where you are in the globe. And for us, that's about investing in companies, like vaccinations, market-leading disinfectant, diagnostic companies, healthcare equipment like heart rate monitors, blood pressure monitors, testing equipment like large laboratory microscopes. So really companies that support those social outcomes from a patient perspective and aren't profiting necessarily from disease, if that makes sense. So to give an example, one company we invest in, it's a market leader in early stage detection of cancer cells. They run 6 billion diagnostic tests a year, every year. I mean, the social impact of that is phenomenal. Significant real world example of positive, sustainable transition, and particularly important given the demographics that we see on an aging population basis. So that gives you some feel for the types of companies that you would find in the portfolio.
Wow, fascinating stuff. Just two more questions, if I may. Firstly, and if you recall the slide Mark showed about under the sustainability disclosure requirements the FCA is discussing at the moment, your strategy, where would that sit? Would you sit under sustainable transitioning or sustainable aligned, or have you not done that analysis yet?
So I unfortunately, because I was in the green room, I couldn't actually see the slides. But we did give our consultation on the disclosure, or the early stage consultation, which I know we're leading to next year. And I think at this stage, I won't. Depends on where the labelling gets to in the context of those requirements. We will label accordingly for when we get that clarification.
An unfair question, perhaps. And lastly, I've had a question come in, presumably from a younger person, just saying, what's your view on the sustainability of the investment management industry itself? And do you see the sustainability side of it as a primary draw for the next generation of employees, managers, and clients?
Oh, I hope so. I really hope so. I mean, if we get this right, the day that I don't have to label ourselves as a sustainable fund because capital markets are intrinsically sustainable, will be a remarkable day indeed. We don't see that happening. You pointed to the short-termism in the market. We saw that accentuated in September last year with some of the fossil fuel dynamics in the market from a supply and demand perspective. It's a fascinating question. I hope so. Would be my response. And I do take that point. The frameworks, the harmonization, the standardization of being able to comparably analyze these companies on those border externalities are beginning to be built now, which there is no reason in the next decade why the broader capital markets cannot position themselves on a more sustainable basis. In the meantime, we'll have product labeling to get us there. But that would be my aspiration. It's a great question.
Thank you, Abby. Well, if the government and the regulator are to be believed, and if the evidence we're starting to see amongst clients continues to manifest itself, maybe it'll be sooner than our worst fears. So we look forward to that. I'm afraid that's all we have time for, but please join me in thanking Abby Llewellyn-Waters for what has been a fascinating session that's just gone by in a flash. This is a very exciting, it's a very important, it's a crucial part of our world, helping, as Abby says, to make sure that the stakeholders of the planet, the people and profits, are all balanced as we seek to help all of our clients deliver their financial and responsible objectives in the longer term. Abby, thank you very much indeed.
My pleasure. Thank you, Richard.
I'm now delighted to pass over to my colleague, Anna Mercer, who is going to run the Asset Manager panel. Anna, over to you.
Thank you very much, Richard. Good morning, everyone. And a warm welcome to the final session of this event. Also, I would like to wish you a very happy new year, if one can still say that halfway through January. Apologies for the feedback. My name is Anna Mercer, and I'm head of 3D research at Square Mile. For the next 40 minutes, we will be focusing on the direction of travel for sustainability, starting with how we actually define sustainability and then communicate that. And we'll then be considering the big themes that everyone's been talking about and what we can expect next, frameworks such as the UN Sustainable Development Goals and the ever-evolving legislative landscape. To discuss this, I'm absolutely delighted to introduce our wonderful panelists. Next up, we have Amanda O'Toole, the lead manager of the Clean Economy Fund, the co-manager of the Global Thematics Fund, and a clean tech thematic specialist at AXA Investment Managers. And last, but by no means least, we welcome Jens Peers, CEO and CIO of Mirova US, an affiliate of Natixis Investment Managers. Good morning and welcome to you all. Before we kick off, I wanted to remind all of you watching that this is your chance as our fourth panelist to ask these industry experts, you and your clients, burning questions. This can be done via Slido, and time depending, we will try and get through as many as possible. So to the first question, Amanda, I'd like to start with you, if that's okay. What is your definition of sustainability, and how are you helping advisors and investors to understand that and how it works in practice?
So our definition really is coined in response to the suite of sustainable funds that we have in-house at Aegon Asset Management. And there are many asset managers that have their own definition. So our belief is that sustainable companies are those that are looking to do good in the world, to provide solutions for a lot of the problems facing humanity today, which will cover environmental issues such as resource sufficiency and climate change, but it will also be social issues such as healthcare, diversity, innovation in medicine, etc. We also believe that investing in a sustainable way supports long-term resilience and management of material risks, and that will positively impact society in time. So in a practical sense, we believe we're seeking to invest in companies that make an impact through their products and their practices, rather than maybe a more traditional impact fund. And how we help advisors and investors is through training sessions, communications such as our sustainability soapbox, as well as good disclosures surrounding our strategies and stewardship activities. And of course, we're always on hand to answer any questions that any of our clients have got.
Brilliant, thank you. And as we've heard throughout the sessions today, there is a kind of multiple uses of the term sustainability and lots of different kind of language being used in the market at the moment. So Amanda, it'd be great to hear your definition of sustainability and if it differs much or how you're kind of communicating that with your clients as well.
I think conceptually, as an industry, we are largely coalescing gradually around something closer to agreement around sustainability. But the fact that we do all still have slightly different definitions, I think is a reflection of one of the big challenges for our clients. And it's an area, I think it's important that we're very clear and keep trying to clarify what exactly it is that we're trying to achieve through products that are labelled as sustainable, so that our clients can pick what works for them. For me and for AXA Investment Managers, sustainability really is about resilience. I think you've heard a little bit about this in the last session from Abby. And really, to me, currently our economic activity is operating way beyond the boundaries of our natural and human capital. And that's only possible because we're not internalising the costs of degrading, particularly the natural capital that we have available to us. And as we increasingly recognise this and start to internalise those costs, either through regulation and legislation or through consumer choices dictating spending and therefore differentiating in terms of sort of the market price of sustainable and unsustainable products, those natural capital costs start to be recognised in economic terms. And as we see that happening, we ought to start to see a differentiation in the outlook for businesses that have recognised this from businesses that have not. So therefore, a sustainable business model is one which has recognised these issues and started to work towards addressing those risks, both through limiting their own footprint, but also through mitigating their exposure to climate risk. Those businesses that have done that most effectively, I think, are best equipped to navigate the coming decades where we do start to really crystallise these costs. And then I guess there's a final class of business models which is actively setting out to address the challenges that we face in this transition towards a sustainable future. Those businesses whose intention, whose reason for existence is trying to solve some of these problems. And that's a specific class of businesses which we view as being impactful businesses through their products and services. And I know that's something we're going to come on to discussing in a little bit more detail. So I think I'll leave it there with the message that for me, sustainability is about genuine resilience.
Yeah, thank you. And Jens, if you would like to kind of come in there and we'd like to hear your views, that'd be brilliant. Thank you.
Yeah, sure. So at a minimum, I think sustainability is defined, at Mirova, in a very classic way. It's just, as a company, as an economy as well, it's aiming to reach your own objectives and your own goals without jeopardizing the opportunity set, I suppose, or the capability of future generations to also reach their goals. So at a minimum, sustainability is the opposite of unsustainability. But also we see that many of our economic activities today are clearly not that sustainable and basically are weighing on the opportunity for future generations to actually reach their goals in a balanced and sustainable manner as well. So apart from making sure that companies we invest in and projects we invest in are not unsustainable, we also make sure that as we are transitioning as an economy to a situation where that is more certain and more sustainable as well, that we invest in companies that offer solutions to others to actually achieve that as well. So positive impact has also been a very important part of that definition, and to define what is sustainable and not, because we're working in an international environment. We're a very international company as well. We have offices around the world and we're dealing with different cultures. Even to define what is sustainable or not, we were loosely defining that based on sustainable development goals, to make sure that we understand for each sector what the potential unsustainability is, but also what are the things, the projects, the processes you can actually do per sector, because that's different for a bank, for instance, and for a resource company. But what can you do to actually make that better and help others to achieve that level of sustainability?
So now we've set that context, I'd actually kind of like to move into some of those high-level themes and really unpick how we actually do that in reality. So we did hint about this area in terms of themes and that kind of more individual level context of company level. But so climate change has been a main focus for many in 2021. And I wanted to know what are kind of the themes that you see shaping the sustainable investment landscape in 2022, and if climate change will still stay at the forefront, or if you see something else like social issues, for example, taking more of a centre stage. Amanda, if we could start with you, that would be brilliant.
Sure. Happily, having been looking at the businesses that are trying to address climate change for decades, it has given me great pleasure to see the progress that we've made in recent years, both from a mainstream recognition of the need for change and the innovation we've seen through products, such that it's actually possible to make some of that change now, through to businesses actually committing and starting to make the investment. So it has given me huge pleasure to see the focus that has been placed on climate change. I have many reasons for optimism associated with that, but we are a long way from achieving what we need to do in this regard. I think that is recognised by a very broad range of clients who will continue to deploy capital sort of consistently with their personal values, and therefore increasingly trying to support the sorts of solutions and businesses trying to make the transition. So I think we will continue to see growth here and a lot of investment opportunity as investment in innovation sort of keeps accelerating and finding new interesting solutions to the problems. Each problem you solve creates another. You look at electric vehicles, well, that might be a step forward from combustion engines, but obviously we need to address the energy supply system, and obviously we need to address the upstream battery supply system. And there are sustainability challenges in both of those areas, which sort of businesses are now working to address. So that's the first thing, is I don't think we are anywhere near done with the climate change thinking. But we are certainly detecting a significant pickup in interest in biodiversity and natural capital, a growing recognition that this is a really, really pressing issue, and that we simply cannot afford to continue degrading that natural capital globally at the pace we are, and that it's such an urgent problem. Businesses are working towards addressing it. There is progress through COP15 with regard to setting out a sort of top-down structure in this regard, and we are starting to see progress in terms of reporting and disclosure on this issue. And obviously both of those things are very helpful towards investment in this area, where I do think we're going to start to see more and more of a pickup. There's also interest in water and issues around water quality, water scarcity, which is in some cases a sort of an implication of the climate change challenges that we face. So certainly both building resilience into that infrastructure and also addressing water scarcity is significant. The other thing that I think is happening is that more broadly, clients simply wish to align their own investments with their personal values. So in exactly the same way that a consumer business will tell you its sustainable products within its portfolio are growing most quickly, and that their customers want to know what the environmental footprint was of anything from a pair of jeans to the fruit that they're buying. Those customers are our customers too. And increasingly what we're seeing is that they want products which are aligned with their personal values, with the way that they choose to spend their money in other areas. And so I think we will see a proliferation of demand for the different solutions associated with those different interests.
Thank you. Okay, so client-driven demand for investment products that are aligned to their personal values. And then you also mentioned biodiversity and natural capital, and the fact that we're definitely not done with climate change is kind of an overarching point there. Jens, I'd like to come to you. In your 2025 video, you mentioned that you believe women and millennials are going to be a huge kind of source of economic pressure to drive this change. And I think that would pick up on some of the themes there that Amanda was mentioning in terms of that personal values and trying to kind of drive change around that. Would you agree with those points, or would you like to highlight any others in terms of themes that you see coming to the forefront?
Sure. No, I think, it's really important. And I agree with Amanda that, climate change is certainly not going to go away anytime soon as a theme, and that, biodiversity is very important, albeit relatively early in terms of how we can actually implement it, specifically in a listed equity or listed bond portfolio. But as an industry, there's a few of us, and I think all three of us are in this panel as well, are very actively working on this to hopefully have a framework in a couple of years' time that we can implement. So that's really important. But what we're seeing, specifically, we're headquartered in Paris, and climate change has, of course, been a very important topic there, and biodiversity as well. But we're also based here in, with my team here in Boston, and in the US. Climate change is important, but social issues, specifically around diversity, are becoming a lot more critical in a different way than it used to be, a slightly different way than what it was or is in Europe. I mean, gender has been a very important driver in Europe, and it's coming here as well. And there's a lot of initiatives on in all regions in the world to get companies to commit at least to having more women in management and not just in boards. I think that's really important for us as well, to kind of have women in management, not just in controlling positions and in a small group of people around the board, but really have a day-to-day decision making as well. But we're also looking more at broader diversity, but which is also a challenge, because racial diversity, sexual orientation, religion, all that, these are topics that are difficult to measure as well. And with different cultures around the world, in some countries it's illegal to track that information. In other countries, it's actually used as a tool to incentivize companies to do the right thing. So we're still looking at a big and important evolution. But from our investors' point of view, it's really important for returns. It's also really important, and you mentioned it already. Millennials, women, Generation Z as well, are more sustainably orientated in general as well, not just as a consumer. But as they become more and more, managers and decision makers in companies as well, it's really affecting the behavior of the whole economy and companies in general, and that in return will also impact performance of companies in the market. So social issues become a lot more important, and specifically around diversity for this year, we believe.
Thank you. And Miranda, is there anything you'd like to add there on the thematic front?
There's not much I can add, but
we have covered quite a lot.
Yeah, I absolutely agree with what they said. We've got over 30 years experience in developing portfolios that are directly related to our clients' belief systems. So, climate change is something that we've been dealing with for kind of 30 years as well. And we absolutely see that the momentum is not going away despite the COP disappointments that we had. But again, also on social justice is something that our clients find quite important. So yes, diversity is part of it, but really understanding companies taking responsibility for what's going on in their supply chains is something that's quite dear to a lot of their hearts.
Brilliant, thank you. And I think all of these themes kind of relate to one of potentially the biggest thematic frameworks in the industry at the minute, and that is the kind of United United Nations Sustainable Development Goals. I was wondering, Jens, what are these, if you could set kind of some of the context, just so we're all on the same page, and how do you apply them within your investment management, and how you relate these themes to those?
Sure. Well, the United Nations Sustainable Development Goals are a set of 17 goals that in 2015 were agreed upon by all the member nations of the UN, which is quite unique, because that basically means that everybody has actually adopted those, but they were never aimed to be a framework for the asset management industry. Of course, they were really political, tool and framework to help countries to set goals, to achieve a more sustainable economy. They were actually a continuation of the Millennium Development Goals, which were a set of, I believe, 8 goals set at the end of the last millennium as well. And when they looked at them, they were quite vague, but they also saw that we had achieved significant economic growth, but not necessarily kind of better sustainability or social inclusion, or climate change was still very important, etc. So in 2015, we wanted to update that, set those goals for each of those 17. They range from fighting poverty to focusing on gender equality, quality of water, climate change, biodiversity, sustainable cities, etc. But not only would it lead to more sustainable worlds, and again, like these goals are set also for and defined as sub goals even per country as well. But not only would it be defined in terms of sustainability, but also if we reach those goals, we would actually achieve an additional 12 trillion in economic value. So it's really that economic element was really important as well. What we've seen, however, like in our industry now as well, is that more and more, specifically initially institutional clients or investors, have adopted that framework as well, for reporting purposes, for instance. So that's already a bit of a risk, because again, they were not designed, for the asset management industry. I want to say at the beginning that we use that loosely, or we use those loosely to define what is sustainable or not. We basically look at them conceptually. So if you're looking at no poverty, we're not really going to look at what companies are doing in Tanzania now, for instance, specifically, or for gender equality in specific Asian countries, etc. We use that as a concept and look at how companies are implementing those. Have developed frameworks for each sector in terms of what's the potential risk. Some countries, some industries have more of a negative impact or a positive potential impact on things like climate change. Like for a bank, that's a bit less important than it is, for instance, for an energy company. So again, per industry defined, what are the sustainable development goals that are really important for you, and how do you actually address both the risks and the opportunities that that can actually have to achieve positive impact. And then, from there, we developed a rating mechanism to help us as a portfolio manager as well, to identify what companies actually, should we not have in the portfolios, but specifically as well, how can we maximize the exposure to positive impact on those sustainable development goals. But again, to finish on that, it's a loose framework, and there's a risk that, that our industry is pushed in a specific reporting direction. Specifically, if I look at what's happening in the industry right now, many companies are asked to report on revenues or exposure to sustainable development goals. But how do you, for instance, measure revenue exposure to gender equality? That's something that is impossible to do. So I'd also warn against using that framework, only and only that framework to measure the sustainability exposure of a strategy.
Thank you very much. Miranda, I'd like to bring you in here because, as kind of Jens has hinted at there's probably some fears of misuse of these goals and issues of rainbow washing or greenwashing more broadly. I'd like to know your thoughts on this, and also how you're kind of working to address these concerns.
Yeah, absolutely. So, as Jens said, it really was designed for governments to raise the standard of living in poorer countries. So you can't argue with that. It's very ambitious and something we would like to support. But a lot of the targets underlying those goals are things that you can't really invest in. They're not things that most of the companies are having to deal with on a daily basis. Health and well-being, a lot of it's to do with infant mortality. But that doesn't stop a lot of companies from labeling themselves as being aligned to SDG 3, which is the health and well-being one. So my concern really is that there is no single body that's got oversight of the claims being made by corporates that are aligning themselves to these SDG goals. So you can badge yourself with whatever SDG you like, and there's really very little consequence. In my experience, having looked through companies that we've invested in, there is a well-known tobacco company in the UK that's aligned itself with 8 of the SDGs, including health and well-being. You know, it just doesn't make sense. And also a multinational oil company who is known for being very reticent on climate change transition strategies has aligned themselves also to 8 SDGs, including climate change. So I am, very concerned that these things are being misused and that rainbow washing is prevalent within the industry. What do we do about it is we really understand the companies that we are investing in, bottom-up research, fundamental analysis. What do the companies do? How are they helping build a sustainable future? And much as the SDGs have caught the imagination of advisors and of clients, we will report as an output, but we do not use the SDGs as an input into our investment process.
Thank you. And Amanda, I'd like to bring you in there for your views.
Yeah, it's, I think as we've covered, the SDGs set out some really important goals and aspirations. And behind each of those goals, there is a set of targets. And I think those targets give us a lot more insight into what we ought to be thinking about when we're thinking sort of corporate activities and how they are aligned or contributing. And there are also some specific KPIs associated with each of those targets. So in practical terms, I think where one has chosen a strategy of investing towards specific sort of positive impact targets. So for instance, in the case of the strategies that I work on, I've set out to invest in businesses whose products and services deliver improvement against specific environmental challenges. Now, we can align those specific areas of sort of aspiring to improve with some of the targets associated with SDGs. And whilst, as Miranda says, this was not the original purpose of the SDGs, it wasn't the point of them. It is, I think, sometimes a helpful shorthand for communication with clients because it's something that most people understand, they're very well publicised. And where we're identifying targets which are specific to the goals we have within the product, what I think we're then able to do is put to one side the sort of reporting that suggests that a business is aligned with all 17 of these goals, and we see that a lot, and perform internally quite a granular analysis of a business's activities to try to work out where those activities are aligned with, and more importantly for an impact product, contributing towards a specific target, and looking for KPIs that we can use to demonstrate that alignment and contribution, where we can measure a business's progress, measure the contribution it's making, and then we're able to start to hold to account the investments that we have and the management teams of those businesses, because where we see a lack of progress or an outcome which is sort of insufficiently impactful, obviously it's something we're able to engage and discuss on. And so I think what's really important is having a framework to assess the activity's contribution. Typically these days, an impact framework will encompass considerations of intent. So that's the extent to which a business's management team is focused on achieving this better outcome. It will consider materiality, so the extent to which this is relevant to the business and beneficial to the sort of global solution we're looking for. It will consider additionality, the extent to which this business is doing something that is better in terms of achieving that positive outcome. And then we're looking at the sense of doing no harm, those negative externalities, which is actually increasingly important, I think, from an impact perspective. And very rapidly, actually, if a business is doing something which is an unintended side effect that's negative, that will start to crystallize as an economic cost. And it takes us back to that thinking of, is this business model resilient? And finally, clearly, we need measurement. So I think what you need, if you're going to harness the SDGs towards sort of articulating the impact of the strategy, is this clear, granular analysis of what a business is actually doing to contribute.
Okay, and then just in terms of that kind of clear, granular analysis and how you communicate that meaningfully to your clients and how you kind of actually show the solutions being provided by those companies, how do you go then on to kind of report that in a concise and accessible way? I believe with the language was the phrasing used by the FCA earlier, but also how you kind of use that in a way that's, they can understand easily. And as you mentioned earlier, it's that idea of then being able to link their personal values to their investment. So how do you kind of take all that fundamental granular research and analysis and that understanding of what a company is meaningfully doing and then transport it onto clients in the form of reporting? So, I didn't say who I'd like to start with there. Apologies. Sorry, that's my fault. I got so carried away. But yes, if I could start with you, Amanda, that would be brilliant. Thank you.
I think what's absolutely critical in this area is that we start by setting out very, very clearly what the intention is of any given strategy. So what exactly the objective is, what we're trying to achieve. Because if we set that out clearly and honestly, then our clients should be able to make a decision about which product is right for them, because there are many different ways to approach this. And I think what's important is that clients understand the choices they're making. So I think that's the first thing to do. And then the second thing to think about is to ensure that the reporting and the output that we're producing reflects our progress against those objectives. It has to demonstrate how we've achieved those things. So for an impact strategy, the strategies that I work on, I have a dual objective. I have a financial return objective and I have an environmental objective. And those two things are equally important. Incidentally, I don't view them as a trade-off. I think if you get the latter right, it supports your market share and so on and so forth. But what that means is I have as much of an obligation to my clients to report on the environmental outcomes as I do the financial outcomes. And it would be insufficient to say to a client, you've got to trust me on what the financial return was. I don't see that it's any different with the environmental return. So what we do is we try to pull together the top-down portfolio level contribution. So the first thing we do is we articulate the proportion of assets within the portfolio that are contributing to specific SDGs. That's a kind of a high level, gives a bit of an outline of what this product does. And that helps clients to start to think about whether this is the right sort of product for what they're looking for. And then behind that, what we do is we offer through our impact reporting sort of a number of environmental metrics that are quite broad-based. So things like carbon intensity and water intensity and so on and so forth. But actually, I think we have specific KPIs that we manage the portfolio to against the benchmark. So we also disclose on those. And for me, they are around the extent to which there is what's described as climate technology within the portfolio versus the benchmark. And it's not dissimilar to the sense of a green revenue, I guess, and of sort of patented technologies that can deliver the solutions. So we report that against the benchmark. And then finally, what we do, and I think this is actually the most illustrative, is sort of single stock examples and case studies. But we heard Abby speak earlier on about, litres of water saved across the portfolio and so on and so forth. So we will report metrics like that. But actually, sometimes it's more interesting to look at a single company level. So where I have a precision agriculture business, for instance, what's relevant is the number of hectares that have been improved in terms of processing. You can't aggregate that up across a portfolio that also holds renewable energy and so on and so forth, because you end up with a meaningless number. So that single stock reporting as to what individual holdings are contributing, I think actually can be the most resonant. And obviously, coupled with this, we need a report around the engagement that goes on within a portfolio.
So lots to pull out there then, and try to compile it into one report. Jens, is there anything you would add there?
Yeah, sure. I mean, for starters, I would want to come back a little bit to what both Miranda and Amanda were saying. And I think on the one hand, it is very dangerous, I suppose, to really rely on what companies are saying. So it is critical to actually rely on our own research or the research of any other manager and understanding what their credentials are in terms of sustainable research as well, because we need to kind of place it all into the right context. Obviously, a lot more mainstream managers now going into sustainability as well. And relying on a single source of information, and not necessarily the companies themselves, but also ESG data and rating providers as well. But it's very difficult and actually impossible to bring back a full sustainability opinion of a company and its processes, its products, impact, what's happening in the supply chain, etc., into a single number or a single rating as well. But yet, if you want to simplify things, that's basically what you need to do to some extent. And to come back to what Amanda says, I think it's important to, on the one hand, show a sustainability profile for a portfolio overall. You can call it almost top down, or just a general macro overview, but also drilling down into the companies themselves. Again, it's complex. A company may have a positive impact on gender equality, but potentially have a risk or a negative impact on things like health or climate change, etc. But it's really important to actually aggregate it up to a portfolio as well to actually generate a full profile. And for that, we've worked together with some universities as well, like the University of Cambridge, to also drill down the 17 Sustainable Development Goals in 3 key areas of impact on the environmental and 3 on the social side, to really kind of show that. We also, there's always this balance need to find between a subjective opinion and something that is very quantifiable. Take gender equality now, for instance. We've talked about women in management, but looking at the MSCI world, there's only 14% of the managers in the companies, combined companies of the MSCI world, so 1/4 that are female, for instance. So we're showing that number as well. We're showing that relative to our portfolios. Let's say for a global equity portfolio, still a low number, is 20%, but it's very difficult to find companies with more than 25% female managers, for instance, as well. So we're showing those numbers individually, doing that for things where we can, like gender, women in management, not necessarily gender equality completely, but women in management, for instance. Also for climate alignment, where we will show carbon emissions, but also the avoided carbon emissions, by investing in solutions, and translate that into an overall number for the portfolio in terms of climate alignment. So just to cut a long story short, I think it's really important to show the overall numbers for the portfolio, show, if you can, real numbers, but also an opinion on sustainability of the overall portfolio, but then also explain on a company by company basis, more anecdotally, I suppose, what companies are doing and what your engagement activity is related to those companies and their behavior.
Brilliant, thank you. And Miranda, I think those are themes that kind of resonate with you and your views on reporting as well, but I'd be interested to see how you think reporting or kind of evidencing sustainability and progress is going to evolve moving forwards.
Yeah, I mean, I think there's been a proliferation of reporting initiatives coming out in the past couple of years. A lot of it centered around engagement and voting, which of course are very important issues for our clients, the stewardship of those activities. But we run the risk of that becoming an industry in its own and actually losing sight of what do these funds actually do? What are their purpose? As the other 2 speakers have already highlighted, the funds that we're running have got very particular strategies and objectives. So, we wouldn't want to lose sight of the fact that we do have to thoroughly explain to our clients exactly why we invest the way we do, what our objective is, what are we hoping the outcome is going to be. But of course, remaining that transparency for our clients to understand exactly how we do it.
Brilliant, thank you. And we've had a few questions from the audience. I'd like to throw them out to you, if that's okay. And Miranda, I'd like to come back to you to start with this one. How do you oh, no, sorry, that's not what I was to ask. What is the expected holding periods of your investment, given that these issues are long dated, but managers can be paid on a yearly performance basis?
Well, happily, gradually, the industry's remuneration, I guess, is becoming slightly less short term. There is obviously probably still a way to go. But in terms of the way that I think about an investment horizon, you're right, these issues are very, very long term. Typically, we are thinking about, so I invest in products and services that are delivering these solutions. So I am invested in everything from the kind of solutions to the energy transition, renewables, the smart grid, and so on and so forth, through low carbon transport, ag, and businesses which are preserving natural resources. So for me, what I'm looking at is the scale of the opportunity as the global economy starts to make the transitions that we require. So I'm looking to size addressable market growth over certainly the next decade and longer, because clearly these are significantly long-term transitions. You think about something like net zero, a lot of the commitments are 2050. So the kind of the demand for these solutions is only going to start to come in over that kind of time frame. And really the investment horizon, it varies. I would suggest 3 to 5 years is really what we're thinking about at a single stock level. Within that, there are times when valuations can become challenged and we might see better opportunities elsewhere, and you might sort of trim a holding and add to another holding where perhaps the valuation is more appealing. But broadly speaking, we're looking at a 3 to 5 year investment horizon, which I think is sort of appropriate for these kind of considerations at a single stock level.
Great, thank you. And because we've had quite a few questions come in, I'm going to now move to another one. And Jens, I'm going to ask you, do you believe that sustainable strategies will gain the largest share of the advisor market over impact, exclusion, responsible, fill in, whichever other term the industry is currently kind of going on as well?
Yeah, well, I may be a bit biased on that one, but yes, of course. There's multiple reasons for that. It was already mentioned, before, but clients want to invest a lot, or investors want to invest a lot more in line with their values. That's one. But secondly, the offer is getting better and better as well. So, we've come to, the situation that specifically in continental Europe, but more and more in the UK, and starting now in the US and Asia as well, that, the default choice is becoming the sustainable option, no matter how you define it. There's still many different definitions for that. But if you can get the same performance out of, if you look at 2 or 3 different strategies, if you can get the same performance or better, from a strategy that has a better sustainability profile, then you get something additional. So, even from a performance point of view, not just, investing in line with your values, but even, people that are looking purely at, only at short-term performance, even like, if you get the same performance with a better sustainability profile, that will always get, the priority right now. That's one. Secondly, we have regulation coming up as well. SFDR in Europe may become a lot more, global as well. It's a very important market. It will be linked to MiFID. So basically what that means is that, advisors will have to ask their clients a list of questions, not just about, risk and return, but also about what they expect from a sustainability point of view. And based on the answers of that, they may not necessarily have, even a regulatory choice, but they may have to offer, sustainable investment solutions only potentially to this very specific, part of that market. And it means that, there's going to be, again, more and better products coming to the market that will actually answer that need, and that in turn will drive that demand a lot more as well. So it's a long answer to say yes.
Great, thank you. And Miranda, there's a question that's been asked here, and I think it's quite interesting because it potentially reflects some questions that have been around as sustainability has been gathering momentum, in terms of in a rising yield environment, which is triggering a massive rotation in value stocks, which tend to be low in terms of their ESG ratings or kind of performance. How do you expect your clients to respond? And essentially, I think the person's trying to ask is, do you see your client base as kind of being loyal to the product for its sustainable investment intentions and kind of actions, or do you see it more as because obviously there's been a strong performance in some of these areas over recent months?
Well, as an asset manager who's been around in this space for a very long time, we have a very long-term outlook. And yes, there has been a huge rotation away from growth. And our flagship fund is a growth-oriented fund. So obviously, performance has been dented. At the moment, we've not seen any reflection in client flows as a result of that. And I think that goes back to what we were talking about before, where people are looking for funds that reflect their personal beliefs. And so I think it is that the people that are invested in our fund, they are willing to hold out, and they understand the pressures on the likes of a strong ESG focused fund is going to be higher in growth than it is in value. So at the moment, we've not seen any impact from that big rotation.
Well, I'm very glad to hear that, and I think your colleagues on the panel will be too. Unfortunately, our time has come to an end. I would like to say a huge thank you to all of you, Miranda, Amanda, and Jens, for taking the time to share your views and your expertise on sustainability. There are so many takeaways from this panel, and my mind is absolutely buzzing. But I think in terms of themes, we're saying climate change is here to stay. It's going to broaden out instead of focusing solely on kind of the energy transition piece, to look at biodiversity, water, and the social issues are also coming to the fore. Fundamental research and analysis is key, as is meaningful and kind of easily accessible reporting. And that people are really committed to sustainability. And that's the note I want to end on, because optimism is key. That's what all of you three have said. There's many reasons to be optimistic. So thank you so much for your time today. And a big thank you to you also, to our audience. We hope you enjoyed our event, and please do take the opportunity to provide us with feedback and to complete the questionnaires. In terms of the Responsible Pathway events, we will be back with a bang for our series finale on impact come the 22nd of February at 10 a.m. See you there and have an absolutely wonderful week.